Welcome to a new episode. I have the pleasure to talk to Hugh Cutler, the Chief Commercial Officer of Mobius Life, a company that connects institutional investors with the assets, opportunity, technology, and ideas that they need, and that has won multiple times the Institutional Investment Platform Provider of the years, many years in a row, from professional pension. And this pension world is something I definitely want to explore further with Hugh. But Hugh, at first, I would like to welcome you here.
It's great to be here, George. And talking about some of my favorite topics of pension and investment. So thank you.
Wonderful. We're going to go into all that. But as I was looking you up, I realized that you are an actuary. And that's something that I'd like to learn a bit more about. So you can talk to us about your background, but also this specific role of actuary, which I think is a regulated function. So even if I'm good in medicine, I cannot say I'm a doctor. If I'm good at maths, I cannot necessarily say I'm an actuary.
That's fair enough. Yeah. So the actuarial qualification is basically it's a series of exams you have to take in finance, pensions, insurance, and various sort of bits of maths. Historically, actuaries were very focused on kind of how long people were going to live and life insurance. But over time, they've moved from just doing life insurance, also general insurance, pensions, investment, and all kinds of sort of risk management sort of roles. And like you say, a lot of actuaries have a sort of regulated function. So if you're a pension fund, you have to have an actuary sign off your valuations and things. If you're an insurance company, and they're specific regulated roles, I don't do any of that. I did the exams 30 years ago, did the qualifications, thought, yeah, this is pretty interesting and I've learned some good stuff, but I was really passionate about investments. And once I'd done the exams, I moved into the investment management sphere and worked for a number of big and successful asset managers and some small successful ones and one or two others as well. So, but an interesting career of investments. And then, in the last couple of years, I joined Mobius Life. It's a business I've known since before it was Mobius Life. So, for 20 years or so, watched it grow, knew many of the people. And when the opportunity came to join it, and, at this point in my career, really passionate about helping people with pensions and savings and sort of trying to help individuals actually end up in a place in retirement where they've got a dignified retirement, they can afford to live, they're getting good value out of the financial services industry. And so I'm really passionate about that. And we play a small role in that, but I think a very important role in making sure people get a decent retirement.
Wonderful. So let's talk a bit about that, because as I said in introduction, was perhaps a bit vague to the listener about Mobius. You connect institutional investors with assets, opportunities, technology, ideas. But how does it work in practice? And maybe we can take the example of pension funds if you want, because I know you don't just cover a pension fund, but other types of investment managers. But let's.
So how we operate is we look after the assets for pension funds. If you're a pension fund in the UK, you've got a pool of assets. If you're a defined benefit pension scheme, those assets belong to the pension scheme, and the pension scheme has made promises to the members to pay specific levels of benefit, percentage of their final salary for life. Typically, we look after the money. We make sure it's invested in the right managers for them, make sure the rebalancing, all the cash flow, all the reporting, all the monitoring, that kind of stuff is all done. For defined contribution pensions, which is kind of where all the growth is in the UK now, and it's what people have, and auto enrollment, and that's where people basically have their own pot of money. We're then taking those individual pots of money, they get aggregated up, and again, we put them into underlying investments across a range of asset managers, a range of different types of assets, private markets, public markets. We can use derivatives. We can use all sorts of things to build portfolios for those individual members. And, it's governed by, the pension funds and the trustees and their advisors. So there's a lot of people in the chain, if you like. But when it comes to that actual take the money, make sure it's invested in the right place, that's the piece that Mobius is doing. And it's all around technology. It's around regulation. It's around cost and tax efficiency so that, money doesn't get wasted and money is in the right place at the right time. And ultimately, that drives better outcomes for the pension members.
And you say you put the pension assets, let's say, in the right place so that I don't repeat you. But it seems to me that there's a perhaps fairly complex ecosystem. You spoke about asset managers, trustees, etc. I think it would be interesting for us to understand a bit more who are the players there and how Mobius fits into that.
So if you think about how a pension scheme works, there are individual members that put money in, or their employer puts money in, or typically they both do, and that goes into a pot. That pot of money is legally governed by the trustees of the pension scheme. So if that's a individual company pension, that might be the Barclays Bank. I'm a member of the Barclays Bank pension scheme because I used to work there and so it's the trustees of the scheme that are in charge. If you go to a master trust, say a Smart or a NatWest Cushion, someone like that, they have their own trustees, but they're not affiliated to a specific company. They run for multiple companies. You could be in a pension scheme that was run by an insurance company that was a sort of a personal pension contract, or by a self-invested personal pension where that would be again a sort of independent trustee. But at some level there's these trustees or governance framework that's actually responsible for investing the money. And then in the securities markets, there's equities and bonds and private companies and real estate assets. That's ultimately where the capital is going to end up. So what the trustees need to do is work out how they're going to get that money into the securities. Typically, actually selecting those securities or finding the real estate or private companies to invest in, that's done by specialist investment managers. But getting the money from the individual member's account into all of these investment managers, and then working out what the total value of all of those assets is every day, so that the individual members can put more money in, take money out, rebalance their portfolios, whatever they want to do. Somebody has to provide all of that plumbing. And that's what we do, is basically connectivity. So we're not selecting securities, and we're not picking, real estate assets to buy. We're just making sure that the money actually flows to down the right pipes into the right places, and then valuing all of those assets and bringing it back so that the ecosystem works. So we're that kind of connectivity in the middle. Like the way I describe it is we build the pipes. We don't take the water out of the river or the oil out of the well or whatever, or the electricity from the wind turbine. That's someone else, and we don't plug it into your toaster or the electricity or the water out of your tap at the other end. But we're the bit in the middle. We're the pipe or the cable or the connectivity that connects those things together. And it's maybe not a particularly glamorous part of the industry, but it's very important. And doing it in a really efficient way, very low cost, not wasting any money on tax, not spending any money on unnecessary fees, making sure that the money's invested quickly, making sure that the prices are accurate. All of that stuff is super important. No one's going to thank you for getting it right, but they're going to be pretty cross if you get it wrong. And it's really just about great technology, smart people, and understanding that ecosystem.
Oh, I'm sorry if no one says thank you, Hugh. I think it's very important actually this is what the podcast is about, not necessarily to thank you, but to understand how the pipes works and exactly that. And is there efficiency? Is there something that, ultimately affects the ultimate beneficiaries? That's the stuff that we try to understand here. So it's already been very enlightening what you discussed. And to zoom a little bit further into this. So we understood there's the pensioners, the ultimate beneficiaries. There's, let's call them trustees to simplify, or there's different things there. Asset managers that serve them. So who are your clients and how do you work with them specifically? And if you can take specifically, you mentioned, and I saw on your website, there's Smart Pension, Cushion, which are perhaps not traditional asset managers.
Our clients, we've got 700 and something clients. Most of them are pension schemes of UK companies or insurance companies or asset owners of that type. A small number of these master trusts, which is kind of a massive growth area in the UK, and a Smart Pension and NatWest Cushion are two of those master trusts. They're both very technology enabled, fast growth businesses, and it's really exciting to work with them. So they're who our clients are: pension schemes of companies, insurers, these master trusts. We have some retail pension clients as well, where we're sort of providing services more directly, not directly to the individual, but to a SIP, a self-invested personal pension that's for the individuals. So they're who our clients are. And then we work with the asset management industry very broadly. We've got about 80 asset managers that we're working with today, 900 different investment products that strategies that those 80 or so managers are running, and our clients basically can pick any of those 900 strategies in any mix they like. And so in fact every day we're pricing about 12,000 different portfolios, so basically combinations of those assets that our clients want.
So that's where I understand the platform, right? There's this, let's say, offering, and then there's this selection that's possible, and it's matching. And you work with, for example, the master trust in the case that we discussed. If something needs to be introduced that is, for example, not an asset manager that you have, how does it then work?
Yeah. So we add new strategies and new managers all the time. So it's a continuous process. And if a client wants a particular strategy from a particular manager, we'll add it. Now, obviously, there's work involved, there's legals, there's connectivity that we need to build. So there's a commercial decision to be taken.
Sure.
But we've already got 900 funds. I would expect by the end of the year, we might have 1,000, right? It's going to grow. And there's new strategies coming out all the time. And I think a lot of the growth in recent times has been around things like private market exposure. So you hear about the Mansion House Pact and the agreement to put more private markets in. You've got obviously the previous government and this government very focused on the growth agenda. They want capital from savers in the UK, from pensions in the UK to flow into productive finance. So UK venture, UK infrastructure, UK companies. And so a lot of those opportunities aren't in the listed markets, they're in the private markets. And so getting those kind of strategies available. And so that's been a big focus for us in the last couple of years, is broadening out the range of private market exposures. We've done infrastructure, real estate, private credit, private equity. We're working on launching the first venture capital investments for UK defined contribution schemes. So we're kind of on the forefront of adding those kind of assets, and that's going to just continue to evolve over time. So yeah, more privates, but there'll always also be more public market strategies. And I think as the industry matures and people pivot from being in the savings phase, accumulation phase, and move more into the retirement decumulation phase, basically people get older and they start spending their money instead of saving it, then it gets more and more important to have a wider range of strategies. Because, if you're 30 years old and you're not planning to touch your money for 40 years, it matters very much what you invest in, and it matters very much what fees you pay. But probably the answer is to invest, at least in the last 40 years, the answer has been to invest in index tracking global equities and forget about it, right? So that's kind of the default strategy. And if the market falls 20% when you're 30, it's kind of good news, right? Because next year's contributions are going to buy more shares. I mean, it doesn't feel like good news, and of course,
Yeah.
But that's
Dollar
the
cost
reality.
averaging,
Yeah, pound cost
enjoys
averaging, all of that.
volatility and stuff like that. Yeah.
But when you're 65 and you're spending the money,
Mm.
pound cost averaging works in reverse. And so you have this sequencing risk issue where if markets fall, if you're spending, £10,000 a year, when markets are down, that you're selling a lot of shares to get that £10,000. And so pound cost averaging works in reverse, and that's very painful. And so then you've got to think much more carefully at retirement about the sorts of assets you hold.
Wonderful. So there's a lot of things that I want to explore a bit further there. You talked about private market sequencing, decumulation. We're going to go into it. But one thing I wanted to wrap up with on the technology side and on the offering side is how does it look on their side before they start with Mobius and after they start with Mobius, and what are the ultimate benefits?
There's a few small differences where we're bringing in like faster technology, quicker processing of transactions, lower costs, things like that, which are kind of minor improvements that we would like to deliver to our clients. We think that our technology, the straight through processing, the connectivity, the way we're hitting market prices, and the costs we can save it, we think are all very, very good. But the really big change is actually just in flexibility, because we're an open architecture platform. So most of the people that are offering the same sorts of solutions to a smart pension or cushion or whoever are closed architecture, in the sense that they're running their own asset management. And so if they're running their own asset management, they don't really want to be diverting money into other managers. Whereas if our business, we only do this, we are exclusively a platform for delivering these solutions. We're not our own asset management firm. And so it's all about that open architecture. It's all about choice. It's all about flexibility. So we were the first people to invest in a long-term asset fund, an LTAF in the UK, first person ever to do that. We're going to be the first people to do venture. We're the first people that have done private credit for DC. We've done synthetic, derivative-based solutions. We've been the first. And the reason we've been the first is because we're focused. And the reason that we're focused is because we're independent, in the sense that we don't have any conflicts. We're just open architecture. Whatever assets you need, if there's a way of making it happen, we'll make it happen.
Okay, I understand much better now also why you're, going back to the mission, connecting institutional investors with whatever they need, and the subtlety in the platform. Because in fact, yes, I was thinking a platform is kind of a marketplace where you have, but open architecture platform, I think that sums it up in my mind. That also makes me think of the marketing question, because you obviously have a compelling offer. And I really think those small improvements in cost and efficiency, in time, etc., I think ultimately that's something that matters enormously for the end investor. I'm a disciple of Jack Bogle, if you want, and I feel like, every time we manage to lower those fees by 1 bp, it's a big step.
It's worth having, yeah.
And my previous guest was Eric Baltrinas, who wrote the book on Bogle, and said, okay, 1 trillion saved for investors or something like that cumulatively. So I think what you're doing ultimately on the behind the scene is very important to understand for people like us who like to nerd out on investment management. And ultimately that's really matters for the end investor. And therefore the question is, indeed, it's kind of a subtle thing to understand. If you have a very compelling offer, how do you address this potential marketing challenge? What are the challenges that you face to broader adoption?
Yeah. Well, so one of the advantages we have from a marketing perspective, it's a consolidating and quite concentrated market. So there are 25 consulting firms that advise pension schemes, which is, I didn't even know there were 25 before I joined Mobius. I'd have, if you'd asked me 2 years ago, I'd have guessed there were probably 15. Well, there are actually about 20. We talked to 25, and there are probably others. But it's a quite small group of people. And if you look at the master trust industry, that's quite a small group of people as well. I think there are like 30 odd master trusts listed regulated in the UK. They're all on the regulator's website. So you can get to them pretty easily, find out who they are pretty easily. And so it's quite a small group of people. Yes, we want to do marketing, and we want to tell the story, and we want to be on LinkedIn, and we want to be on your podcast, and we want to talk about people, of course. We want people to know who we are. But actually, when it comes down to it, probably 100 institutions in the UK that we really want to get to know really well, and 1,000 people. And so it's a sort of hand-to-hand, approach. We want to go and spend time with people. We always like to start from what's the problem that they're trying to solve, because those problems are different. If you're a commercial master trust, it's all about cost savings and an attractive asset mix and speed and communication and streamline. And so that's where they're coming from. If you're an institutional pensions trust on the DB side, it's probably more about kind of investment flexibility and access and service and transitions and rebalance. So there's slightly different services that they need. And then once you get into the retail pensions world, into these SIPs, that's where it's really about things like tax efficiency, where our solutions are potentially much more tax efficient than what a lot of people are doing today. And when you're talking about like the odd basis point, we think we can save tens of basis points. So there's slightly different sort of features for different
Hmm.
for different audiences. And also some people are very focused on, oh yeah, I've got to get private markets in because I believe in it and that's critical to my path. Other people are like, oh no, I'm done with private markets. It's all about, how I can get the lowest risk or the lowest fees. And so kind of starting from that, what problem are you trying to solve? And we've got to, like, we do one thing. Within that thing, it's really pretty flexible, right? We've got a lot of choice, we've got a lot of funds, we've got a lot of technology. We can build things for clients. So it's, yeah, that's how we think about the challenge. But I think certainly in that retail pensions world, wealth managers, advisors, platforms, SIPs, in that world, I think there's probably a bit of a gap between what's going on today and best practice. Whereas if I think in the institutional pension side, they're very professional, very sophisticated, very well advised. It's about incremental, save a basis point, speed things up, save a pound. It's about small incremental gains. I think on the retail side, there's the opportunity for a bit of a kind of industry transformation and to really develop solutions that are way cheaper, that have much lower tax leakage, much greater flexibility. And that's really important sort of for everyone, but it's absolutely critical for that cohort of people that are now coming up towards retirement, where this sequencing risk comes in and things like tax and cost leakage are really painful, as well as, having limited flexibility in terms of investment.
No,
But yeah,
there's a lot to cover there. We're not going to be able to cover everything, but let's try to cover some of it. Let's talk about sequencing, decumulation. You've got an interesting presentation on decumulation, a scary one as well.
So you start with £1 million, you take out £40,000 a year, increasing with inflation. If you don't have any volatility and you just get a very steady return, that money lasts for 34 years. But if you start to run with and look at kind of what are the bad cases, often with these sort of 10 or 15% volatility, the money runs out in 10 years.
when you're 65 and you're spending the money,
Mm,
pound cost averaging works in reverse.
mm,
And so you have this sequencing risk issue where if markets fall, if you're spending, £10,000 a year, when markets are down, that you're selling a lot of shares to get that £10,000. And so pound cost averaging works in reverse, and that's very painful. And so then you've got to think much more carefully at retirement about the sorts of assets you hold. You need to generate income. You've got to be very careful about things like tax efficiency. Costs are always still important, but volatility, it really is your enemy when you're taking your money out. Whereas when you're saving, yeah, volatility is not a great thing, but it's kind of your friend. Pound cost averaging sort of help. You then have to have a much more well thought through, if you like, investment strategy when you're at retirement.
it's not something that we think a lot about, but I understand it's a critical question when you pass these years and therefore you decumulate. It's supposed to be a good time. Maybe can we just give us an overview on that? I will link the presentation you've done because I think it's very interesting, and we'll see how we can address it.
Yeah, so it's the start of my presentation I did online. The Bill Sharp, the founder of the Sharp ratio, and obviously, big Nobel Prize winner, he said that this kind of decumulation problem is the hardest and nastiest problem in finance. And it's very hard because you don't know anything. You don't know how long you're going to live. You don't know how much money you're going to need. You don't know what markets are going to do, and you don't know what order they're going to do them in. And so it is this really difficult challenge. And I'm a pensions actuary originally by trade. I've worked in investment for 30 years. I come from a long line of doctors, father, grandfather, sister, all doctors. So if anyone should have a good idea about these things, like how long might you live, how much money might you need, where should you invest it, it would be me. But it's just a hard problem. And there's this great example. I don't remember all the numbers, but broadly, if you started in 2000, and took your money out. I think you start with £1 million and you take out £50,000 a year, and you start in the year 2000, and you increase the amount you take out every year with inflation, and you invest your money in the stock market. You run out of money after about 20 years because what happens is the first thing that happens is you have the tech crisis, right?
Yeah.
And your equities plummet in value, but you're taking out this money every year, which is going up with inflation. And then you sort of recover a bit for a couple of years. And then you have the global financial crisis. And so then you really hurt. And then by like 2012, like markets do fine from 2012 to 2024, 2025. It's great. Markets have been great, but it's too late because you've already suffered the loss. But if you'd started in 2023 and run time backwards, after 23 years, you'd still have the £1 million you started with, even having taken all that income, because the returns just happened in a different way, right? Yeah. So you had 10 good years and then you had a crash. And so this kind of sequencing risk sort of really matters. And so then you've got to go and find assets that have the right characteristics of relatively stable value and relatively high income. You don't need the best total returns. You just need stable returns. And so that points you towards different sorts of asset classes. And those assets, for example, income paying equities, high income equities, equity strategies that use guarantees to prevent really big drawdowns, like structured type guarantees, credit assets that pay, high stable values, asset-backed securities, CLOs, things like this, right? You've got all of these asset classes that have those characteristics. Those asset classes aren't available to retail investors in their traditional pensions. They're available to the sophisticated big pension schemes, the master trust, the DB schemes, but your retail pension investors can't get to that. And then the other problem the retail investors have is most of the funds that they use pay withholding tax in the fund. And so if you buy global equities with high income, you end up giving away 0.5% a year in tax. And that's very painful. And then, of course, you've also got then the fee problem. Like if you're paying an advisor a high fee to advise you on these things, that's going to eat into your capital as well. And so I think the opportunity to build highly tax efficient, highly cost efficient, very well diversified portfolios using the right kinds of assets that work for decumulation, that is a huge gap of what's available today to savers in the UK, particularly to sort of retail pension savers. And you're talking about £1 trillion of savings on behalf of tens of millions of people. And the solutions just aren't there, and the advice structure isn't there to deliver it. So it's a real challenge for individuals, and it's a real opportunity for the industry to evolve what they're doing and bring much better solutions to market.
So that's understand the issue and the potential solution, but the question is, how do you get there? Because first, those things are not available. So even if I followed your presentation, I'm fully on board, I cannot do it. And secondly, not everyone is following these types of things. And there's a massive education, knowledge gap, etc. So we've talked to the PLSA, they've got this, pay attention to your pension campaign, but if you see who they chose for the campaign, which is a reality TV star, etc., it's not the same audience target that we're discussing about here. And it seems like we're at the level where it's about, pay attention to your pension. It means, hello, you have a pension, not like, hello, you have a pension, you've invested safely, but now watch out for the decumulation. So yeah, it seems like a big gap, multiple levels of gap there.
It is multiple levels of gap. And I don't believe that there is some kind of magic bullet solution to this. It is a mix of things. Education is vital, right? So, I think children in school should be educated about finance. It should be a core part of the curriculum. There should be availability of education. I think education that's coming from independent and, places is very important, because I think the problem with a lot of, particularly now, obviously social media or online, you can go and find somebody to present to you on an idea, but what's in it for them? Are they qualified to give you that education? Are they just talking their own book? Are they like, I've made £1 million this morning trading crypto. Even if it's true, it's not useful to people, and it's probably not true. Having that education piece is important, but it's also like if you need to have medical treatment for a serious ailment, you have to have your appendix out. It's like a bit of education that says, hey, if you've got a pain in your tummy, you might need to go to the doctor. And if that pain's getting worse, you probably need to go to the doctor pretty quickly. So that is useful, but it's not terribly useful to explain, oh yeah, well, this is how you take your appendix out. And so I think really where financial education, so people have awareness, the big GC or whoever's like saying, oh, you got to look at your pension. That's all great. But then what you need is a structure where people can get guidance. I think one of the challenges for the advice industry is it's become so very highly regulated that it's become prohibitively expensive to give advice. And so it's not really, most people can't afford financial advice. And then there's another group of people that can afford financial advice, but they end up with advisors that charge them too much and don't give great advice. And it's really only people with enough education and experience to know what they're looking for, who understand how to get financial advice, that end up with good advice. And so there's a real challenge there. But I think what the PLSA are doing, there's a lot of innovation around financial education. I think what a lot of challenger organizations are doing, whether that's in the master trust space with people like the Smart and Cushion, whether it's in the retail savings, the Nutmegs and Monzo and Moneybox, all these, there's all of these people that are doing clever things that are sort of driving the industry in the right direction. So I think there's a lot of good things happening. I think we just need to continue to focus on it. We need to continue to work hard as an industry. And I think the regulators and government have a big role to play in navigating the industry so that regular people can get fairly priced guidance and support for their investment requirements without having to get very expensive structured advice. And I think there's a lot of good work going on in that space, but there's an awful lot more to do.
Yeah, the educational piece, and perhaps education is not necessarily the right name because, like you said, I mean, you don't need to be an actuary to manage your pension. And at the same time, now the pressure is on us, right? People say, hey, you're irresponsible for your pension. And then we're, as you said, we're often stuck between finfluencers, let's call them like this. And I also see a lot of companies completely, using this opportunity, which of course they should do. And I don't mean they necessarily give bad advice, but they call themselves universities, Blackstone University, Apollo University, etc.
Yeah.
Obviously, they have a very strong bias towards what they said, and I don't think that's the solution either. And what we discussed with Alicia from the PLSA is that, indeed, just to go back to your point about those new platforms, etc., technology could be part of the solution, because if suddenly things are immediately available, presented in a way that's engaging to you, those things can make a big difference. And it's not necessarily about having to put my finance hat on and going through this.
I think AI is very interesting in this regard because everybody's a little bit different. They all have a slightly different risk profile. They've all got different amounts of money, and they've also got different families. So, everybody's a little bit different. But broadly, there's a few sort of broad themes that kind of work, and they work consistently, and they're pretty similar for people. And so what you need is a kind of an advice process that's low cost and picks up those nuances and diagnoses what needs doing for that individual, and then gets it ready to be implementable. And I think kind of AI advice models are coming. I think that could be a great way. Even just algorithmic advice kind of works, right? You put in a few facts and it follows a routine and it comes out with an answer. But I think you can do a lot better if you take an algorithm and use that.
That's what I've tried to do. I've loaded the scripts of my podcast into chat box, and I've created the private equity skeptic bot, which doesn't necessarily criticize, but gives more nuance on the private equity side. It's not perfect yet. It's very easy to do, but you have a lot of prompting, and it's not like it's just using the good information, well, based on my bias, of course, that feed her, it's a lady. But basically, if you can pull a lot of good information and then instead of feeding it, have what's a Gen AI, something where you can ask questions and they need human answers. That's where the tech is very exciting. But to go back and also to finish, because we're running out of time, to what you're doing and perhaps try to connect it with what's happening in the UK, the Mansion House speech. And one of the things they said is potentially private assets, new types of assets as part of the mix. So how does it play out? You mentioned that you're able now to connect those things for pensions, but how is this playing out specifically?
Yes, what we've done for some of our larger, more sophisticated clients is create these multi-asset funds. They design what they want in it. We just make it happen. But we can include private assets within that. So there's these LTAFs that have been, UK regulated, kind of semi-liquid vehicles that can invest in private markets. You can use those. They have some advantages, but you can also use other types of private assets, and you can just hold those within these multi-asset portfolios. And the reason people are doing it is not really to support the UK agenda, right? Because it's like the trustees, they've got to do the best for the members. There's a belief that they can get attractive returns, they can improve diversification, they can reduce volatility by broadening out the range of assets they're investing in. And that all makes sense. I think as your skeptic chatbot, you need to make sure you understand what you're doing. The private markets, by definition, come with light regulation. They tend to have high fees. There's a massive asymmetry of knowledge between the buyers and sellers of some of these assets. And so you have to be very careful how you do it. But nonetheless, if you do it well, the opportunity for enhanced returns, smoothed returns, increased diversification, and also particularly for commercial entities that are trying to also attract clients themselves, and also for just member engagement. If you say put a wind farm in your portfolio, or we own a wind farm, you could even have the situation where your app tells you when you're near the wind farm, right? It's all connected. So you can sort of have these things that get people engaged and interested. So it's a way of drawing people into the pension, both in terms of making that provider attractive because they've got interesting assets and they're doing interesting things and it's ethical and it's social and it's environmental. It's all good. It attracts people in. And also once they're actually invested, if they can vote on the companies in their portfolio, or if they can see the assets and feel the assets and know that it's doing a good thing, they're then engaged. And then because they're engaged, they put more money in, they have better retirements. Because they're engaged, they understand the decumulation, they start to get drawn in. So I think there's a UK economic agenda, an environmental agenda, or potentially a social agenda with some of these private assets. There's a risk return opportunity, let's say, whether it's going to deliver or not. But if there's a risk return opportunity, there's definitely a diversification benefit. And then there's these kind of engagement factors that of draw people in. So I think there's a lot of reasons for doing it. We've done a lot with these bigger, more sophisticated trust type investors. Yet to do a lot in private markets on the retail side, but I think that will happen. And again, I think we think our infrastructure is a powerful toolkit to make that happen.
Now that's such an interesting aspect, the multifaceted elements of investing, which are also emotional and stuff like that. And I remember I was involved in a startup that also tried to get people to invest, and I was actually angry with them because they offered a Ferrari at some point, and I thought, like, come on, why not? But let's be serious. But they told me it's not about the Ferrari. The Ferrari is a very, very small percentage of the assets. But hey, they're so engaged, and then people might buy this, boring index fund, etc. So this is a psychological aspect I wanted to ask. So that's the thing that Mobius can do. You can say this wind farm, if you are keen to invest in, it needs to be packaged. It needs to be probably a fund. It needs to be a regulatory wrapper. That's the kind of thing that you can enable.
And we're not doing the whole thing end to end. We're playing a role in the middle, but it's a critical role, and transforming a private asset sitting in some kind of partnership or vehicle or private company and turning that into something that a regular member of a pension scheme that's putting £200 a month into their pension can have exposure to. And it's going to be a tiny little percentage of their portfolio. And it's probably going to have a pretty small impact on their risk return profile. But it might just get them to go, wow, oh, I'm doing something useful here. I believe in the environment. I am supporting it. So I'm going to put another £20 a month in, and I'm going to read my pension statement, and I'm going to engage. And if they do that, the chances of them having a successful outcome go up dramatically.
So if we go back as well to the whole process that you told me earlier, it's about the trustees ultimately working with asset managers that will provide that. And I can see how, we can translate it to a very public campaign. And that's why we also connect with the pay attention to pension and all that. It has a diversification benefit. And I think one thing we can say is that, more access to more things is, at least in theory, always a good thing. Then the caveat is those things can be marketed in a non-appropriate way. But I think that's to me, now that we had this conversation, that gives me a much better understanding of, how we can solve some of the challenges and how Mobius plays an important role into that. So it's not the glamorous role. You said it, I haven't said it. but the access, the efficiency, the cost reduction, and also all those, you mentioned tax and stuff like that, I think I can better understand how it ultimately feeds into the pensioner. And this is what's important here. So I think that's a good time, to stop and reflect on all that, because that's a lot, unless you have something to add.
No, that's great. It might be a small part of the puzzle, but we're very passionate about making it happen. And we're very passionate about, people just ending up in a better place. And whatever we can do to help make that happen, we're keen to do it. So it's great to have the chance to talk to you. Thank you for your time and interest. And yeah, good to meet.
Wonderful, yeah. And that's exactly what this podcast is about. We're going into investment management. This is not an investment podcast. We're not going to give you the next idea or the next macro outlook. It's about discovering those things that ultimately really matter. And I mentioned Bogle as a source. I also like to mention Shiller, the Nobel Prize laureate, who said, we need to reclaim finance and these intricacies for good. So you need to connect those details of finance, those, let's call them boring, but they're not for the people who listen to this, with how it works and how that benefits people ultimately. So I think that's what you've done very eloquently, Hugh. So I thank you very much for your time. I'll post the links to Mobius, to that presentation on decumulation sequencing, and people can also comment and ask questions if they want to know more. We'll make sure to answer.